Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from ChartsAndMarkets.com runs down the major markets. The broad U.S. stock markets lost some of their momentum after a lengthy charge upwards. The yen is on an upswing. Dr. Marc Faber joins us from exotic Thailand to chat about the war on cash and the effort to swing us towards government digital currency, the real rate of inflation around the world, and whether Canada is a good place to live. Publisher of thetrendletter.com, Martin Straith, tells us you'll be surprised by the countries with the top-performing ETFs and that the U.S. and China are ready to face off in a computer chip war. He also has special offers for our listeners. Plus, at the end of the show, we'll have a company showcase update from RecycLiCo CEO Zarko Meseldzija. We'll talk to Ross Clark right after this.
RecycLiCo, making lithium-ion last forever. RecycLiCo's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. RecycLiCo Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMY.ZF, and Frankfurt ID4. For more information, visit RecycLiCo.com or phone us at 778-574-4444. RecycLiCo, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from ChartsAndMarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show.
Good to be with you, Jim.
How did the markets end up this week?
Well, beginning of a new calendar quarter, so we no longer have to do a lot of rebalancing and show, those top eight companies being a big part of portfolios. And guess what? Markets lost some of that momentum. We've been just had this fabulous stretch since March, some very, very small pauses along the way. And, here we are this week. Finally, the broad markets down anywhere just over 1%. And, we take a look at really some of the high flyers like Apple, which is down 1.5% on the week. That is actually the worst week since it bottomed in February. Not dramatic, but guess what? $3 trillion, I guess, is sort of a lid as far as Apple's concerned right now, and would be very nice to see some little corrections here. Some of the big names in the last week and a half have pulled back to their 20-day moving averages and bounced. That is sort of the norm when you're in one of these strong trending markets. Ideally, I'd like to see it take out those supports that we put in this last 10 days, get a better correction, and that can set us up for something in September, October that becomes a much more attractive point to spend some new money on. There's some rotation going on. Clearly, as you say, the big eight stocks are taking a pause, and some of the other areas are coming to life. You take a look at the energy stocks. You take a look at the mines and minerals. There's some life over there. So there's always value to be had when the momentum slows down.
What's going on with crude?
Bit of a surprise for me. I've been hoping that we would have one more good hard sell-off down into new lows, but I guess with the cutbacks in production, it's starting to have a bit of an impact. Closed up just shy of $74 on the West Texas crude. And the 20-week moving average, which is what we're looking at, is a major resistance level. It sits right here at 73.90. The relative strength index is at 48, and if that RSI moves through 50, and it won't take much more in terms of momentum next week to do that, that would also then take us through that 20-week moving average, and would suggest that a base is in place a little prematurely for the modeling that we had, but you have to go with the directions as they occur, and at this point, it looks as though there's, better than a 50-50 chance that oil has put in a low at this time.
Anything going on with the precious metals?
Yes, the gold market tested support very nicely here in this last 10 days or so. This week had a decent week on the upside. You're looking at a market there that we've been looking for a base to happen in June or late June through August. We've had good tests of support at this time, and any follow through on the upside has a chance to gain some legs. I think the real momentum, even though we might put in a low, the real momentum on the upside is probably a month or so away. But for those who are looking to establish longer-term positions, you want to be still looking for any corrections at this point to start delving in, whether it's into the bullion or pick some of the good stocks, the GDX. Take a look there at the big stocks in the ETFs and look at those as potentials. Now, the U.S. dollar at the end of this week took a bit of a hit, and that was supportive to both gold and silver. And I think also, if you take a look at it, it might have been a bit of a help to that crude oil market. We still, if you look at the dollar index, it's pretty much in a trading range. It does have resistance up at its 20 and 50-week moving averages, just a shade above where the rally took it in this last week or so. But as of Friday, started to trend back down again. And looking at the euro, that one is clearly in an uptrend with a nice pause and has some upside momentum to it. The one that stands out here in the currencies is the Japanese yen. A week ago, we started to see numbers on the commitment of traders that were getting into extremes that we hadn't seen in quite a while. And, we take a look at the relative strength and with the Bollinger Bands as far as the commercials and the non-commercial positions. And those were getting out to extremes a week ago. We're still seeing that as of this week. And from a pricing point of view, we've had just a really, really good hard break in the yen. And it started to turn as of this week. The daily charts put in capitulation lows, and by the end of the week, we're closing up above last week. I think the yen is one of the better trades here for the next couple of weeks. So, something that we usually don't talk about, but where, the idea here is when you're a trader, you're just looking for opportunities, and wherever they jump out at you, back 2 months ago, it was the grain markets. It was corn, wheat, and soybeans that we don't normally look at. Now we've got the Japanese yen, so just go with the opportunities where they are.
Ross, thank you so much for the update.
Good to be with you, Jim.
My guest has been Ross Clark from ChartsandMarkets.com, where you'll find insightful market commentary and timely technical analysis. Find him on Twitter at ChartsByRoss. Coming up, Dr. Marc Faber, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Dr. Marc Faber. He's speaking to us from Chiang Mai, Thailand. Marc, welcome back to This Week in Money.
Well, thank you for having me.
Marc, how are things at the Gloom, Boom, and Doom report, and how can people sign up for it?
Everything is fine, and if people want to subscribe, they can go to the website gloomboomdoom.com. I repeat, gloomboomdoom.com, all in one word.
Marc, let's start with the new world order plan around the world to control and depopulate the people. Do you think this evil will succeed, or are there ways to stop it?
Well, the way to stop is basically the human instinct to survive. So I think most people would not subscribe to a government that wants to reduce the population deliberately. And I'm not sure that this theory of depopulation holds ground. If the issue is less population growth, maybe, but not to reduce it necessarily.
Are increasing death rates affecting markets?
Until now, they have not had an impact. What is impacting markets such as monetary policy is much more important than the death rates. But eventually, if the population doesn't grow and shrinks, like in Japan and in China in future, then obviously it has an impact on economic growth rates.
What do you think the real rate of inflation is when energy and food are included?
This is a difficult question to answer because in different countries we have different cost of living increases. In Thailand, the cost of living increases were not particularly strong in the last 12 months, and in other countries, especially in Europe, they were very high. So, and then it also depends on the composition of the household and how the household lives and so forth. So, but in general, if you live in Canada, the US or Europe, your cost of living will have gone up in the last 2 years by approximately 20-25% over a 2 years period.
Are we in an ongoing bull market for interest rates?
Yes, if you define a bull market for interest rates as a period during which interest rates will go up. I believe that we've been in a bear market for interest rates after 1981. In other words, for 40 years until 2020. And from 2020 onwards, we have a rising inflation and interest rate structure. And usually these trends, they last for a very long time. In other words, we could be talking about an interest rate increase over the next 20 years, whereby periods of rising rates are followed by falling rates, and then renewed increase in rates and renewed fall in rates, but the trend is upwards.
Are banks constricting credit?
In some sectors, the people that need the money, they have difficulties in getting money, and the people that don't need money, in other words, they're very wealthy people, they can get credit.
And they don't need it in the first place. How long does it usually take for interest rate increases to show up in the housing market?
Well, depends on the rate of increase in interest rates, and it also depends on whether interest rates are above the rate of inflation or the rate of appreciation of homes. Say you buy a house and the house goes up by 10% per annum, then you don't mind paying 8% interest on your mortgage. And if the house goes up by 20% per annum, you don't mind paying 15%. You know, so it depends on the overall rate of inflation. But in general, my view would be that interest rates on homes will go up, and it will make homes less affordable for ordinary people. And this is one of the problems of monetary policies, that the expansionary monetary policies have made many items less affordable for young people who just started out working.
Do real estate crashes tend to happen during times of high inflation?
Yes, but the real estate crashes usually occur after inflation has already occurred, and through the inflation, supplies increased, and so then the oversupply depresses prices, and prices go down. And during the bubble, the level of debt in the housing market increased, and so when the prices no longer go up, there are massive defaults.
Could crashing the housing and commercial real estate markets be by design in time for Agenda 2030, where you will own nothing and be happy about it?
I don't think that this is the idea, because the politicians, they want to be re-elected, and if people lose their homes and lose their money on everything, it would not enhance the chances of being re-elected. So I'm a little bit more careful to argue that all these things are intentional. I think the power of the WEF, the World Economic Forum, is grossly overestimated.
Stock markets crashed in early 2020. Could stock markets climb a wall of worry higher into 2024 and beyond?
Possible. If the Fed and other central banks print money, it can go on for a long time. In Turkey, we have a rate of inflation of 80%. And if you walk around Istanbul, everything looks normal. So you could have eventually very high inflation rates.
Do you think gold and silver are about to go for a run?
The question is about to go.
Yeah.
First, they may go lower, and they may stabilize here and go higher. I have argued that you should own gold and silver, and that you should never sell it. And more than that, I can't tell you. No, people who are responsible and want to preserve the purchasing power of their money should own precious metals, period.
We keep hearing the U.S. dollar will collapse, but it's still here and continues in a trading range. What could actually make the U.S. dollar collapse?
Well, there are always people who predict the collapse in this and the collapse in that. And most people just utter this proclamation without solid basis. Basically, as long as the interest rates in the U.S. are higher than, say, in Europe and in Japan, there's no danger of a U.S. dollar collapse. But the dollar could collapse one day if inflation accelerates meaningfully, or if there is a trade war that leads to a currency war. In other words, foreign countries may no longer wish to accept dollars or hold dollars. Is all possible, but it has not happened yet. And it may not happen for quite some time.
Digitally controlled slaves. Do you think the majority of people are dumb enough to accept 15-minute smart cities, digital ID, vax passports, and central bank digital currencies?
Probably people will use centrally controlled digital currencies for financial transactions. When it comes to go out and visit a whorehouse and the massage parlor, or go shopping, or go to a restaurant, or to a bar, or to go out with your buddies and get drunk, I think most people will still use cash.
Are CBDCs likely to be used by some people and not others?
Yes, it is possible.
Klaus Schwab has been working to enslave and destroy humanity since the early 1970s. He says he infiltrates governments and corporations, and his people do not lose elections. Why do you think he's still in business?
Well, one of his great sponsors, Adern in New Zealand, she resigned. So it's not crystal clear that he controls governments, and he does not always win elections either. So but they have a certain influence, and I have to give him credit that he created an organization that attracts businessmen and politicians from all over the world for essentially nothing. It's all BS, but the organization is very profitable, and it's organized, it's well organized, largely because of the Swiss government, but basically nothing is achieved.
Are we likely to see more civil unrest and possibly civil wars and even World War III ahead?
Good question. I think we have in the Western world, I mean, Canada is a perfect example of a leader that is completely removed from the wishes of a typical Canadian. A typical Canadian does not identify with the BS of Mr. Trudeau. And we have the same in France. The typical Frenchman, he has nothing to do or in common with Mr. Macron. And the same is in the case in Germany. And so, yes, there will be more civil unrest, but I'd just like to remind you that in Rome, already early on, say 200 BC, there were riots from time to time, and legions that were not disloyal and rebelled, and yet the empire lasted another 600 years. So the fact that we have civil unrest is not necessarily a disastrous construct. Now, is World War III going to happen? I have educated friends. They are convinced that the U.S. wants war, and that war will happen. I am not sure, because the consequences of World War III would involve nuclear weapons, and the consequences would be disastrous.
Who would win in an exchange like that?
Nobody. In wars, only the war profiteers, the weapon dealers, and the people that deal in like food items and medicine and so forth, they make a lot of money, but everybody loses.
Is the U.S. onshoring of manufacturing spelling the end of China's manufacturing dominance?
The Chinese manufacturing is so incredibly dominant in the world compared to other countries that it will take a very long time to displace the Chinese manufacturing and logistic apparatus. It would be very difficult to displace them at the present time. And the U.S., in my view, doesn't have the labor force to do so.
President Trump was quoted as saying everything woke turns to shit. Your thoughts?
Well, he probably is right about that. The woke culture is the opposite of, say, Aristotle's virtues. And the old Greek and Roman virtues were very conducive to the build-up of Western civilization and Western hegemony already early on, already at the time of the Romans. And so I believe that this woke movement will die out shortly.
In a world of debt, what is the minimum net worth to be a 1%er?
Recently there was a statistic published, I think, in Forbes magazine that showed to be under the 1% requires a different amount of money in different countries. Obviously, say in the Philippines, with $500,000 US, you are in the 1%. The same would be about required in Thailand, I guess, and in Cambodia, Myanmar, and so forth and so on. In Monaco, to be among the 1% requires $7.5 million. In the U.S., I think it requires about $3.5 million. So you can figure out. In my book, if you want to call yourself wealthy, I think you need about $200 million.
Is Ukraine a laundromat or worse for corrupt politicians?
It is very bad for the world. It is a war that doesn't make any sense at all. And there's a huge corruption involved, both among Russians and Ukraine politicians, and especially, and I want to stress this, especially among U.S. politicians.
Do you think people are waking up to the climate change hoax?
What do you mean by climate change? You mean the climate getting warmer or the climate getting colder?
Do you think Trudeau in Canada and Biden in the U.S., both World Economic Forum members, are spending like drunken sailors by design to bankrupt Canada and the United States?
I'm not sure they do this by design. Frequently people overestimate the intelligence of politicians.
It looks like all 338 members of Parliament in Canada are against freedom and the rights of Canadians. When all sides of government are corrupted, how can the citizens of the country take back power?
They can vote these people out and vote new people in. But this is a very interesting political, philosophical question, whether a democracy such as we have will eventually be replaced by a horrendous dictatorship of the bureaucrats. Because the bureaucrats as a unit, say, can form a government that is very autocratic and is much more dictatorial than a single dictator. Because a single dictator, he has to mind his business. He has to be careful not to take measures that will kick him out of power or get him murdered and so forth. But a body of politicians, they are very difficult to kick out all at the same time. So, and they can all blame each other. And so maybe the system will degenerate into a horrendous dictatorial bureaucracy.
A worldwide takedown of humanity is underway. If you lived in British Columbia, Canada, would you stay and ride out the storm, or would you move?
Well, it depends on your character. Most people are not very keen about freedom and personal freedom and so forth. So they're quite happy to have the government help them. They're quite happy to obtain subsidies from the government. They're quite happy to get social security from the government. And then they're not happy about paying taxes, but they don't realize that the more benefit they want from the government, the more taxes will go up. Now, of course, inflation is a tax. Because inflation occurs when the expenditure of a government exceeds the income of a government. In other words, the tax revenue is smaller than the expenditures, and the deficit then leads to inflation.
The Trudeau government... the Trudeau... Sorry.
Okay.
No, go ahead. I'm sorry. Go ahead.
Would I leave Canada? It depends in what position I am. If I'm a refugee from Sudan, maybe Canada is an outstanding option because I get so many free items, essentially free of charge. If I'm a wealthy Canadian and I have options, maybe other countries are more desirable to live.
The Trudeau government just put a second carbon tax on fuel. Is that inflationary?
Yes.
China's economy, what kind of shape is it in right now?
They're not doing well, but there are structural reasons, and then there are cyclical reasons. The real estate market is depressed and may stay depressed for some time, but the industries are doing reasonably well. The profitability is down, but they're still manufacturing, they're still exporting. And it's remarkable how China develops new markets for their exports. It's also remarkable how China imports goods from countries. So the country is doing okay. It's not a disaster yet, but it could go worse. And the profitability of companies is down.
Would China invade Taiwan to take people's minds off an economy that's not doing well?
I don't think that the Chinese leadership wants war. I don't think the Taiwanese want war. But I think the U.S. would be quite happy to start a war.
AI, is it going to be a great thing for humanity? Or I heard from an AI expert, there's a 10% chance that AI will wipe out humans.
It's possible. I'm not an expert, but it's like the Internet. It has very good sides, and for some people it allowed huge productivity improvements, and for most people it led to a dumping down of people because they are playing games the whole day or posting useless stuff on social media and so forth and so on. But everything has good sides and everything has bad sides. And for intelligent people, the Internet is a huge invention. And I suppose AI will be also huge for people who can use it properly.
Overall, are you seeing gloom, boom, or doom ahead?
Well, the global economy is not doing well. The statistics that are published, they show growth, but the growth is measured from the lows in 2020. But if I look, as an example, at casino revenues in Macau, they're up like 100% from the low, but they're still down 30%, 40% from the level in 2018, 2019. You understand? There has been a recovery, but it's not a full recovery.
How can people find out more about and subscribe to the Gloom, Boom, and Doom Report?
Well, it's very kind that you want to advertise for me. We have a website, gloomboomdoom.com. I repeat, gloomboomdoom.com, all in one word.
Mark, thank you so much for being on This Week in Money.
It's my pleasure. Thank you very much. And good luck in Canada with your government.
My guest has been Dr. Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report, online at gloomboomdoom.com. He was speaking to us from beautiful Chiang Mai, Thailand. Coming up, Martin Straith, next on This Week in Money.
RecycLiCo, making lithium-ion last forever. RecycLiCo's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. RecycLiCo Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMY.ZF, and Frankfurt ID4. For more information, visit RecycLiCo.com or phone us at 778-574-4444. RecycLiCo, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News, online at thetrendletter.com. He's speaking to us from Coquitlam, BC, which is nestled in the mountains just east of Vancouver. Welcome back to This Week in Money.
Thank you, Jim. Good to be here.
How are things going at the Trend Letter?
Oh, things are going great. Life is good. Hope you and your listeners are enjoying a good summer.
Can you tell us about what we would find if we subscribe to the Trend Letter?
Yeah, well, we have, our company's called Trend News, and we have 3 publications. So we've got the Trend Letter, which, started back in 2002, publishes every Sunday evening, covers equities, currencies, precious metals, commodities, and bonds. Each issue is about 50 pages, almost all charts, a few key bullet points, and make it really easy to understand. So its focus group would be long-term investors who really just want to get a better understanding of what drives the markets. The second one is Trend Technical Trader. So that's an online service, started as a hedging service, very timely in bear markets, so great hedging strategies. It also now does long positions, covers many sectors, commodities, equities, precious metals, and it includes our gold technical indicator. And so the audience here, generally more active investors, but certainly those hedging strategies are excellent for any investor. And then our third one is Trend Disruptors, so that invests in disruptive ideas, artificial intelligence, virtual reality, augmented reality, cloud, 5G, that sort of thing. Very speculative, and that's for people that are willing to invest in very speculative items and are willing to only invest with money that they're willing to lose.
Martin, is it true that Nigeria was the best performing country exchange traded fund, ETF, in the first half of the year?
It is, Jim. Isn't that crazy? I mean, I don't think many would have thought or forecast that. In fact, actually, the top five would probably surprise most. So the very top one was Nigeria. So we're talking the first 6 months. So 50.5% return. Greece came second at 40.2. Argentina came in at 36 or 35.6. Ireland was fourth at 27, and then Mexico was 26.7. Now, if you look at the other end of the scale, the big loser here was Turkey, down 20.9%. Then we had Pakistan at minus 11.1, Thailand at 10.9, and Malaysia at 10.8. Now, the U.S., the SPY ETF came in at 16.8, and the Canadian EWC ETF came in at 8%. Now, one of the things that's interesting, aside from just the returns on the ETF, Nigeria had a 50.5% return, but they also have a 23% inflation rate. And the real killer to me was Argentina, comes in at 35.6 on their ETF, but their inflation rate is 114%. And then again, the big loser on the other end, you got Turkey, so their market is down 20.9, and they've got an inflation rate at 38%. So interesting numbers for sure.
The first half of the year was positive for the markets in North America, but mostly driven by big tech. What do you see for the rest of this year?
Yeah, well, the AI frenzy certainly pushed those 7 or 8 big tech stocks higher. I'm looking at a 6-month heat map right now, and for those who don't know what a heat map is, it's a map that shows all of the S&P 500 stocks. So there's 500 stocks in here, and each stock is represented by a box, and the size of the box is represented by the market capitalization. So the largest market capitalization obviously is the largest box, and then the color represents whether it's up or down. So a very bright green tells you that was a very high, very, very profitable stock. A bright red would tell you that's the stock that had big losses. So when you look at this map, and what I'll do, Jim, I will post this in, we post market notes in our blog on the trendletter.com, because it's just a great visual image where you just instantly see who the winners and losers are. So as I'm looking at this, what really quickly stands out is those 7 stocks. So you've got Google, big market cap, plus 38% for the first 6 months. Microsoft up 41%, Apple up 47%, Amazon up 55%, Tesla up 129%, Meta 144%, and then the big winner is NVIDIA up 189%. And so what we've got here is we've got, the 6 months of 2023 has really been the great rotation, the inverse of 2022. So in 2022, the areas of the equity market that fared the poorest, so that would be the NASDAQ, technology stocks, growth stocks, they've turned out to be the best performers so far this year. And then conversely, the stocks that performed exceptionally well in 2022, so we're talking energy stocks, value, equal weighted indexes, they've been the weakest performers. You know, the other bigger winners so far have been semiconductors. Probably a surprise to most would be home builders, Japanese Nikkei index, the EU luxury stocks, and then North American stocks. But if we look at what we like to do is look at market sentiment. So what we're looking at here is one of the areas we look at is there's a group called the American Association of Individual Investors. And what they do every week is that they survey their members and they ask them, what are your expectations that the stock prices will rise over the next 6 months? So historically, the average of bullish expectations is 37%. So their survey that they just published the other day, so this week, their bullish percentage came in at 46.4%. That's the highest it's ever been. So clearly, this group is very optimistic. Then you've got the CNN Fear and Greed Index. So that's another indicator that gives a sense of where investor sentiment is. And what they do is they use 7 different indicators. So it ranges from moving averages. They got the put-call ratio. They got the volatility index. So they got a fairly broad range of indicators. And so I'm looking at their gauge rate now, and it's at 80 out of 100. So it's in what they classify extreme greed level. So what that's telling us is the fear of missing out, or FOMO, is in full swing right now. So this is often a contrarian indicator suggesting that we're pretty close to a top here. Now, market sentiment, it'll move like a pendulum. It's going to, it reaches these extreme either bullish or bearish levels, and then it tends to swing back the other way. So when we see the sentiment get this extreme on the bullish end, it tells us that this religion of artificial intelligence is being heavily invested at almost any cost. So that's creating this sizable bubble in sentiment. So this sentiment has pushed the tech stocks to short-term extremes. Now, that doesn't mean that they can't go higher. I mean, the extremes can still get more extreme. But it certainly is telling us that the risk-reward is getting very, very stretched right now. Warren Buffett has a lot of really great sayings. And one of the ones I like the best is, he says, be fearful when others are greedy, and greedy when others are fearful. Well, the masses are extremely greedy right now, so you want to be a little bit fearful, I think. So over the last week and a bit, we've seen that these other sectors have started to join the big tech euphoria. So they're trying to catch up to big tech, although this week we saw things cool off a little bit the other day. But it's an interesting fact. So then we look at that in these last few weeks, we've seen tech stocks rise along with the interest rates. And that's something that we haven't seen up to now. So this is now telling us we've got to keep our eye on that. So going forward, we do expect to see a drop in tech stocks based on how overbought they are and how high this bullish sentiment has become. And ideally, this correction would be really steep in price and really short in duration, and then that would give us a great buying opportunity.
What do you think could cause a steep correction in tech stocks?
Well, one thing that we're keeping our eye on is this chip war that's happening between the U.S. and China, and it's escalating. So the U.S. is looking to further restrict exports of artificial intelligence chips to China. So the Commerce Department right now is expected to stop shipments of chips made by NVIDIA, AMD, and other chip makers to China and other countries what they call of concern. So last year, the U.S. cut off shipments of NVIDIA and AMD's most advanced AI chip to China. Now, what NVIDIA did is they did a workaround. So what they did is they created a new chip. It was the A800. And what this chip, so it fell below the performance thresholds that were outlined by the Commerce Department. So that allowed them to ship these chips to China. But these new moves, the new regulations are going to also ban these lower performance chips. And they're going to force NVIDIA, AMD, and all these others that they will be required to get licenses in order to be able to ship any chips to China. Now, the U.S. is also considering restricting leasing cloud services to Chinese AI companies. So that's what the U.S. has been doing. So that's their side of it. So now China has retaliated. So China is now cutting the exports of critical materials used in making semiconductors. So these are, germanium and gallium are the two key ones that they're doing right now. And because these are critical materials in high-speed chips that are used in military applications, like night vision devices, satellite imagery sensors, radars, communication systems. So, Janet Yellen's over there right now. She's trying to smooth the waters here. So it'll be interesting to see how this works out. And so far, the markets have not negatively reacted to this escalation. But that could change quickly, and that could really have an effect on this whole, AI technology. Also, we could, if that doesn't happen, we could get a recession here, which would certainly disrupt the markets. And then, of course, an escalation in the Ukraine war, China, Taiwan, the Middle East, any of those could trigger a correction. So either way, we're looking for a better opportunity to get back into this market at lower prices. So I think, you can see industrials, technology, and even transports could finish stronger this year, but not till after we see a pullback.
What are your expectations on the Fed and Bank of Canada regarding rate hikes?
Well, every week in the trend letter, we publish the CME Fed Watch tool. And what that does is it tracks the market's expectation of a Fed rate hike. So when I looked at it just maybe an hour ago, it was at 94.9% chance that the Fed would raise rates 25 points at their next meeting next week. So that just leaves a 5.1% chance of another pause. And, so you've got consumer confidence, you got strong wage gains, you got a tight labor market. So those things continue to keep inflation stickier than the central banks would like. Now, on Thursday, we saw the U.S. ADP data, which is based on actual payrolls, and they added 497,000 jobs in June, which is massive. And then today on Friday, we saw the U.S. government data. Now, that's based on phone surveys, and it shows 209,000 jobs. And that's the 30th month in a row of job growth in the U.S. So certainly, to me, that's fuel for more rate hikes to come. And now in Canada, on Friday, we got the jobs data. And again, massive jobs, 60,000 new jobs, which was triple the expectation. Now, the Bank of Governor Macklem, he's pretty adamant on crushing inflation. So I expect both the Fed and the Bank of Canada to raise rates this month. And note, if the Fed raises and the Bank of Canada does not, the Canadian dollar will get hit.
Are you seeing any market indicators of where residential and commercial real estate are heading?
Well, now I would not call myself a real estate expert, but I certainly follow it. And one thing that I do know is that we have a serious supply problem here in Canada, particularly in Vancouver and Toronto. And I also know that demand is ramping up. So, whenever you get tight supply and growing demand, you're bound to see higher prices. So, in Canada, we have a real labor shortage, and the government has really opened up to allow many more immigrants, which should help fill some of those jobs that have been hard to fill. So as a result of that new policy, Canada's population grew by over 1 million people last year, and our total population is now over 40 million. And the target for the next 3 or 4 years, is 500 new migrants each year for the next few years. So that's good news for the labor market. But of course, all of these new residents are going to need a place to live. So that's going to add to the demand side. So while I'm not an expert in real estate development, I do read and hear from those who are in that business. And I read a recent report that in Toronto, it takes 500 or more days to get planning approval for high-density residential development. And then once the developer gets approval, construction will take between 2 and 4 more years. So that process can take over 5 years to get a new building built. And that, to me, that says the ability to bring on new housing quickly seems almost impossible with the current processes in place. Now, I mean, if all that wasn't bad enough, RBC put out a report, last week or week before, and it says residential construction costs in the country have soared by 51% since the start of the pandemic in 2020. I mean, that's shocking. I mean, 51% in just 3 years. So we already knew that land prices, especially again in centers like Vancouver and Toronto, are major costs of building a new home. But that report shows that just due to the impact of the pandemic's lockdowns, we are still feeling the effects of that throttled supply chain. So it says since the first quarter of 2020, materials have escalated in cost, concrete prices are up by 55%, and structural steel is up by 53%. And then we get this other report, this one from CIBC, that's showing that due to the drastic rise in mortgage rates, you've got investors in newly completed condos who have mortgages, they're losing money. So now I know that many people, as soon as they hear the word developer or investor, for whatever reason, they visualize these ruthless, evil people. But if investors can no longer cover their costs, who's going to finance all this rental housing that is so desperately needed? And if investors are not going to risk their money, developers will not have the funding to build new housing units. So from my vantage point, we have a very serious supply problem, which is getting worse with a dramatic rise in cost, plus with higher interest rates, even, investors are losing money, even though rents are higher. And now we've got a population that's set to grow by another 1.5 million over the next 3 years, adding to the demand side. So to me, if you add it all up, I would suggest that residential real estate is going to remain very expensive.
In your last issue of the Trend Letter, you noted that since the debt ceiling debate was settled, the U.S. government got back to doing what they do best, spend taxpayers' money. Is this a big concern?
Oh, wow. Yeah, they are masters at spending other people's money. It's truly remarkable, even for the U.S. government. So here are the numbers. So from June 2nd, so that was when the debt ceiling was raised, till today on Friday, July 7th, so we're talking 21 business days, the U.S. has added $935 billion to their debt. That's over $44.5 billion per day. And I'm not making these numbers up. These numbers come straight from the U.S. Treasury site. So their debt is now $32.3 trillion. And that works out to $96,500 per man, woman, and child. Or if you're a taxpayer, it's $251,000. So, it's unbelievable how they're raising up. And now, because interest rates keep rising, well, the cost to service this debt keeps rising and rising. So in the last quarter, so the fourth quarter of 2022, the U.S. spent a record $213 billion to service their $32 trillion debt. So extrapolated over a year, that would be $852 billion to service their debt. So think about that. They're getting close to $1 trillion just to pay the interest on their debt every year. And so that's $852 billion that doesn't go into, helping the low-income people or, all of these other social programs they want to do. So it's literally just going to pay off the debt. So now the U.S. Congressional Budget Office, so that's an agency of the government. They issued a paper report last year, I think it was last May, where they said the U.S. government would add another $20 trillion of debt in the next 10 years. Now, again, that report is over a year old, and they are already well exceeding that pace. So instead of $20 trillion on top of the $32 trillion, so in 10 years, they projected $52 trillion. It's probably going to be more like $60 to $65 trillion.
Given these huge debt levels, there seems to be more and more talk from people like Bernie Sanders calling for modern monetary theory to solve the government debt problems. What is modern monetary theory, and what are your thoughts on it?
Yeah, well, I mean, if you look back at the pandemic relief programs that were put in Canada and the U.S. and really much of the Western world, MMT was pretty much being implemented then. So the premise of modern monetary theory is that no financial constraint on government spending as long as that country is a sovereign issue of its own currency, which both Canada and the U.S. are. So the theory goes that the government can borrow unlimited amounts of money from its central bank. Now, the big difference with MMT versus our current process is that with MMT, the government doesn't have to issue bonds and pay interest or even pay the money back. The proponents of an MMT are praising it, saying governments could then fund all kinds of social programs and not increase their debt since they wouldn't have to pay it back. So the obvious downside here is that the governments are already spending massively over their budgets, and this is already a major contributor to the inflation problem we got today. So if we're going to give governments now unlimited resources to spend, it would dramatically increase inflation and even hyperinflation, and that would crush the economy. I mean, we just need to look at countries like Venezuela and Argentina, where the use of MMT has caused runaway inflation and has destroyed those economies. I mean, Argentina inflation is up 114%. Venezuela is 429%. So, to me, I think this is a frightening idea. But yeah, many of these politicians, they would love to get their hands on unlimited funds so they could fund all kinds of programs that they call free programs. Now, you and I both know nothing is ever free. There's always a cost. And the cost to me of implementing MMT would be the demise of our standard of living. I mean, we've been complaining about inflation at 8%. Inflation in Argentina is 114. Venezuela is at 430%. I really doubt that the people in Argentina or Venezuela are cheering this economic strategy they've put in place. I just don't see how people can seriously be pushing for this kind of change when we can already see the results in countries where it has been implemented.
Given these large government debts, are government bonds a safe investment these days?
Well, to me, it really depends on the country and the term. So in Canada and the U.S., the yield curve is inverted. So that means short-term bonds are paying a higher yield than long-term bonds. So in Canada right now, a one-year government bond is paying 5.2%. The U.S. is paying 5.4%. Just 18 months ago, the U.S. 1 year was paying 0.25%. So now at 5.4%, that's an increase of 2,000%. So yes, I think short-term government bonds are a great conservative investment, and they're beating inflation. And when was the last time we were able to say that? But we've been warning investors to be very careful buying long-term bonds. So 20-year, even 10-year. Stick to the shorter stuff, because I really do worry about a global sovereign debt crisis. Remember, there's a big difference between public debt, so that's government bonds, and private debt, which is corporate bonds. So when a company defaults, all their assets are sold off. Bondholders get a portion of their investment back based on the return of the sale of all those assets. But when a government defaults, there are no assets to sell, so bondholders get nothing back. And the other big problem to me is once one country defaults, panic spreads. You get investors in other countries around start to look around and say, well, wait a minute, what about our bonds? If you remember back with Greece back in 2012, they almost defaulted. And then we saw Portuguese bonds getting sold off. And then the same thing happened to Spanish bonds because contagion started to kick in. So to me, short-term government bonds are a great conservative investment right now. So 3 months, 1 year, 2 years, fine. But I would not go into long-term.
Gold has struggled recently. What do you see ahead for the precious metal?
Yeah, well, after the April-May double top back at 2070, we've seen gold drop, $150 now. So gold's been trying to form a base around the 1920 level. Now that failed Thursday, where it closed at 1915. But on Friday here, it's rebounded, so it's up about $15. So it's sitting around the 1930 range. So we've been expecting a rally here soon, but we were not expecting it to really do much. Maybe break, 1950, but I doubt it would get past 1960 at this point. So right now we've got that 1920 support level. If that fails to hold, then we're looking at 1900. And if that does not hold on a closing basis, we could see a further decline before we see a next big run for an all-time high. So the numbers to us on our models, near-term resistance is that 1950, 1960. Then you got 1975, 2000, 2040, and then the previous high at 2070. Next key support level, at that 1920, and then 1900, 1880, and then 1825. Now, if it does drop to 1825, that's going to provide some really, really strong support because that was a triple bottom back in September, October, and November last year. So if we do get back to that level and it holds, for our models, I know that would trigger several new buying alerts to our subscribers.
Your thoughts on crude oil?
Oil's it's kind of meandering around. It's been continuing to trade in the range between the mid-60s and $83. Short term, we've got the Saudi and the Russians announced cuts, and that could keep prices elevated. They were up a bit on Friday, I think a couple bucks on Friday. So also any escalation of tensions or blockades, like against China or Taiwan, that would boost prices. But if we get a recession, and we are expecting one like the end of the year or early next year, then oil prices are going to decline because we're going to see lower demand. Now, near term, oil needs to break through that 76 level. I think it's about 73 right now. And if it can't, then I think we're going to be likely to see another test of the March low around $66. Now, longer term, on the demand side, China and India, they represent, 35% of the global population. So, and they're growing, especially China. So that's going to equal more demand. On the supply side, we've had the lack of investment. So, expenditures in the oil sector, they're down 35, 40-year lows. One of the main reasons for that is we've had government taxes, windfall taxes, increased regulation, no new permitting. So you combine all that, and it creates a huge supply problem for the next few years. So we expect to see oil $100 for sure, very likely $150, and even higher over the next few years.
Grains have been very volatile. What's going on there?
Yeah, well, both wheat and corn spiked in June, primarily due to fears of a drought happening. Now, they've both sold off recently as the rains have arrived in those growing regions, so that's been alleviating the worries about a drought. But one thing that we're really keeping an eye on is that Black Sea trade corridor deal, and that's about to expire July 17th. So we're talking, 10 days. So this is a deal that was negotiated back in August where Russia agreed to allow safe passage of grain ships from the Ukraine to primarily to support the African countries that were really having problems with food. So now Russia has now threatened to not renew that agreement until they can get some sanctions lifted. And primarily what they're looking to do, they want their agricultural bank to be reconnected to that SWIFT payment system so that they can be able to accept international grain payments again. So if that deal does not get extended, we would expect to see these grains, and especially wheat, spike higher soon.
The talk of a potential recession seems to come and go. I know in the past you've been saying that a recession is likely. Is that still your take?
Yeah, I at times I feel like we're the only ones that are really concerned about a recession. And I've said this so many times, but there's two very reliable indicators that we focus on, and they have an incredible record of forecasting recessions. And these are leading indicators and not lagging indicators. So the first one is the inverted yield curve. I'm sure I've talked about it on your show before. So the yield curve's inverted when short-term yields are higher than long-term yields. So, that seems counterintuitive, because normally you would expect to get paid more on a longer-term bond given the higher risk. So when it inverts, it's signaling that investors are concerned about the economy and that it's going to decline and that rates will fall, so that they want to then lock in longer term at these current rates because they expect the rates are going to drop. So 1955, so since 1955, so we're talking 68 years, there's been only one time where the yield curve inverted without there being a recession. So, to me, that's a pretty incredible record. So recently, the yield curve's been more inverted than at any time since 1981. So typically, a yield curve will invert 6 to 18 months prior to a recession. Now, the current yield curve briefly inverted in April 2022, and now it's been fully inverted, though, ever since June of 2022. So now we are over a year into this inversion. So if it's, if the range is 6 months to 18 months, and we're already almost 13 months in, that suggests strongly that we're probably going to hit a recession, close to either year end or early into 2024. Now, the other leading indicator is the Conference Board Leading Economic Index. So this, in their report out 2 weeks ago, I think, but they've said, and it's all technical, but their write-up said, we project the U.S. economy will contract in Q3 of 2023 to Q1 2024 period. The recession will likely be due to continued tightness in monetary policy and lower government spending. Now, I'm not so sure about the lower government spending, but this indicator has close to a 100% accuracy in forecasting a recession, and that's exactly what it's saying right now. So, Jim, maybe this time both these indicators will be wrong and there's no recession, but I doubt it. But as investors, we need to understand the impact of recessions, bad and good. So in a recession, stock markets do not do well in a recession because investors become very risk adverse and they become pessimistic about the economy. So sell-off can be very significant, and then panic becomes very strong force. So as investors then, we need to have a plan to protect our wealth should these recession warnings come true. So, I mentioned earlier, we've got our Trend Technical Trader. What it does is it provides all kinds of hedging strategies. I highly recommend people think about that. On the positive side, recessions can present excellent buying opportunities once the bottom is in. So I'm looking at a chart right now of the last 5 recessions. So the oldest one back in 1982, you had tight monetary policy to fight inflation. Well, that's exactly what's happening right now. And what happened there is they had a significant correction. But after that correction, so in 1983 up to 1988, we had a very strong bull market rally. Then in 1990, we had the Gulf War and the savings and loans collapse, and that was the next recession. And again, that caused a big correction in the stock market. But once we got through that, so in 1991, there was a massive stock rally right up to almost the year 2000. So 9-year rally. So then we hit the dot-com bubble, and that caused another recession. The NASDAQ lost 75% of its value. But again, after that recession was over and the market bottomed out, so in that 2003, we had another very significant rally right up to 2007, 2008. And then that was the financial crisis, and that was the next recession. Massive stock market correction. And then 2009, right up to 2020, you had a massive bull market. And 2020, of course, that was the COVID lockdowns. So that was the next recession and the next big sell-off. And then we had the next big rally. So to me, if we get another recession and the big sell-off, it's going to be a fabulous time to buy stocks.
A strike by port workers on the west coast of Canada is underway at the time of this interview and is causing billions in economic damage and hardship. Is there a danger it will permanently harm the country as shipping companies switch to ports that are open and perhaps cheaper to do business?
Yeah, well, I think that, in the last few years, since 2020, I think the average person has learned more about supply chains than they ever thought possible. So, it's unfortunate. Like I feel for everybody. Like, inflation's a vicious cycle. We had the supply chain issues because of the COVID shutdowns. So that shuts everything down. And then we had governments handing out all this money. So all of a sudden you had all this extra money chasing fewer goods, and that was inflation. And so then people's wages all fall behind. And so now, like I say, we've been seeing over the last couple of years, everybody's trying to catch up to the inflation that we had, 8-9% over the last year and a half. So here we are. The U.S. just went through this. Their whole West Coast was shut down for a while. And now it's Canada's turn. And you're right. Was it $800 million a day? I just saw something where, the manufacturers, they got 1.7 million workers, and they can't get their stuff out. It's horrible. You want to let people have a right to negotiate, but you got to take in the big picture as well. And hopefully, cooler heads can prevail. Mediator can get in there, somebody can do something. But you got to have that port open, and that's our livelihood. So much. Vancouver's Canada's biggest port. I think Prince Rupert's our second or third biggest. So you got to get those open.
Do you have special offers for our listeners?
Yeah, we do. So we've got those three services I mentioned at the beginning. So Trend Letter, Trend Technical Trader, Trend Disruptors. So your listeners can save between 40 and 65%. So it depends what you want to buy. If you want to buy any one of those services, you get about 40% off. If you want to bundle a couple of them up, or if you want to buy all three, you'll get up to 65% off. So those specials are at thetrendsletter.com/special order. Also, for each new subscription from your listeners this week, we will donate $100 to Special Olympics. If anybody's got any questions about our services or they can't find those specials, just send us an email at info@thetrendsletter.com. And Jim, as I said earlier, I will post charts that I've referenced here because I think these charts, I'm a very visual person. I think these charts just explain things so easily rather than having to listen to somebody like me ramble on so much. So you can take a look at those. They'll be in our Market Notes blog. And again, that's at thetrendsletter.com.
Where can people follow you?
Yeah, same thing. So the Trend Letter, so all one word, .com, and they can contact us, info@thetrendsletter.com.
Martin, thank you so much for being on This Week in Money.
My pleasure, Jim. Have a great summer.
My guest has been Martin Straith, founder of Trend News online at thetrendsletter.com. He was speaking to us from Coquitlam, British Columbia. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Dr. Marc Faber, and Martin Straith. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@housestreet.com. Now stand by for a company showcase update with RecycLiCo CEO Zarko Meseldzija. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. My guest is Zarko Meseldzija, Chief Executive Officer of RecycLiCo. Welcome back to Company Showcase.
It's always a pleasure to be here, Jim.
Zarko, what's the latest at RecycLiCo?
Well, I really do enjoy doing these podcasts, and I think we've built quite the reputation of being a very transparent company throughout our technology development. And I think we've also educated listeners along the way to a new industry that, as many know, tends to have many, many nuances. And I do intend to keep sharing these periodic updates, but I also want to remind everybody we are in JV mode now, and where time is critical and success will speak for itself. So, just keep a lookout as we progress on any of those public updates. But as a quick update in regards to the Zenith JV, we are working through just a pretty standard joint venture formation procedures, including like the approvals from the exchange, since we're a publicly traded company, and as well the Ministry of Economic Affairs in Taiwan, which is a part in doing making an investment in Taiwan, right? So these are all pretty standard. But despite the standard paperwork, this really hasn't slowed down our technical or business planning of the joint venture itself, right? Because the first joint venture and the success of the first joint venture is going to be closely watched on a global scale. And we've had a lot of meetings on behalf of the JV, but it also hasn't stopped RecycLiCo from planning for more JVs that we do see that we foresee the battery recycling sector needing. And as well, I think we could see this with Benchmark's projections. So Benchmark Mineral Intelligence, they project that the battery recycling sector is actually going to need $24 billion of investment for secondary material to be available for it to meet that future demand. So in essence, really, the way I see it is those who will actually win the majority of this total will be those who either control the waste battery material, right? So how are you going to get your supply, as we've talked about before? And these will be companies such as the OEMs. And I think the other side of it is those with advanced technologies that can offer the most cost-effective, environmentally friendly, and efficient process, because it is going to be a game of margins as well. And I think, we really believe RecycLiCo can marry its advanced technology with those who control the waste material. And overall, I think in the long term, that's going to equate to a lot more JV opportunities. And as a side note, Benchmark also projects that there's the recycling sector needs $24 billion in investment, but the total battery industry itself needs at least $514 billion across the whole supply chain to meet demand in 2030, and it needs $920 billion to meet the demand in 2035. So it's kind of amusing to me as well, because on one end I read about the economy, the global economy slowing down, but on the other hand, the battery industry just keeps booming, and it's always just a reminder of kind of the great position that we're in to be in this, to be such a well-known name in this industry. I also think when it comes to recycling and the changing landscape, we saw that the European Union Parliament voted in favor of adopting updates to its battery directive, and essentially these updates to the battery directive set guidelines for collection of battery waste and minimum levels of material recovery, such as lithium, nickel, and cobalt, from those waste batteries. And as we said before, that the big disconnect here is that, and what we've been saying for years, is that battery recycling has been really been focused on the mechanical shredding process. So taking those whole battery packs, modules, and processing them down into black mass. But there's, and we see that, in North America as well. But with the lack of hydrometallurgical processing capacity in Europe, and as well as in North America, what it really means is that the black mass generated is, currently or mostly being exported to Asia. Now, with the new regulations, that'll increase pressure to keep black mass within Europe. And then that, coupled with the collection and recovery guidelines, will put even more pressure on companies to process their black mass to a higher value product, such as one that, the RecycLiCo process can provide. So, what I'm really seeing here is that we're going to see silos of, the battery recycling industries throughout, in Asia and North America and Europe, right, where the flow of this material, I don't believe will move as freely as it does now or what other materials do, but it'll be, more focused. So, it's more important to have plants in multiple areas instead of trying to bring the material to you in one area. And then just, as a proud Canadian, it's great to see the kickoff of PowerCo's or, Volkswagen's PowerCo, kickoff of the Canadian project. Our government is supporting with $13 billion, and it is going to be a very large gigafactory at 90 gigawatt hours. But, I think, the Canadian government has a lot to push up against with the U.S.'s Inflation Reduction Act, and it's good to see some of these projects coming here. And I think that's going to really redefine the industry throughout Canada and make Canadian projects like ours, as well as just as important with more battery production, more EV production. With that, naturally will come recycling. So as always, Jim, it's always a pleasure to speak with you, and thanks for letting me share some of these thoughts.
Zarko, for people who are new to RecycLiCo, where can they get more information, and where are you traded?
Yeah, you can get all the information you need on our website, www.recyclico.com. And we are traded on the TSXV under the ticker symbol AMY, on the OTCQB under the ticker symbol AMY.ZF, and on the Frankfurt Stock Exchange under ID4.
Zarko, thank you so much for the update.
Thank you, Jim.
We've been speaking with Zarko Meseldzija, Chief Executive Officer of RecycLiCo. I'm Jim Goddard. Our conversation took place on July 7th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.